Hi, Gabriel Josiah here again. Right now, are you ready to crack the code of financial metrics that can shape businesses and careers? In this session, we are diving into the long-term debt to capitalization ratio, an essential tool for assessing financial leverage, managing risks, and making smarter decisions. Whether you're preparing for exams or real-world challenges, stay tuned because understanding this ratio can transform you and how you see financial health in action. Let's dive in quickly as I share my screen. This is our usual custom. Let's look into this unpopular ratio and glean from it how to calculate this ratio. Okay, I've gone in as usual. All right, this ratio is a financial metric that assesses the proportion of a company's long-term debt in relation to its total capitalization, which includes long-term debt and shareholders' equity. This ratio helps to evaluate a company's financial leverage and the degree to which it relies on debt to finance its operations. A higher ratio indicates greater financial risk associated with higher debt levels relative to equity or shareholders' funds. And the formula is clear: the long-term debt exclusive of preferred share capital capitalization. Capitalization has to do with the owners of the equity. It's quite different from the gearing ratio in the sense that the equity portion of the preference, as is always included, is exempted in this ratio. Though it's not a popular ratio, but it has some significance in determining the long-term debt to shareholders' equity, where long-term debt includes all obligations that are due more than a year, excluding preferred stock, while the shareholders' equity includes the total equity held by shareholders. So let's look graphically at the example we've been looking at, Sharp to Nigeria PLC, and let's calculate this ratio very graphically. So let's pick our long-term debt. For the end of the year, we have 450 million. Don't forget, it's exclusive of the preference share capital. So we have our bonds and bank loan. So in this case, we have our total debt, which is 450 million naira. So let's go get our total equity, our shareholders' equity, which includes a total of 1 billion naira. Total of 1 billion naira. Take that, and we have our long-term debt capitalization ratio as our total debt divided by our total shareholders' equity, which is 45%. Now let's have it as a ratio. We have it as 0.45 to 1. That is the proper ratio. So whether as a percentage or as a ratio as we express it in times, this is what it looks like. So let's understand what it means. It indicates what portion of the company's capitalization is financed through long-term debt. A higher ratio signifies a greater reliance on debt financing, and in this case, we just saw less than 50%, 0.45 times to the equity makes a lot of sense. And it's lower risk, in my opinion, or moderate risk, in my opinion, which can increase, or while the lower ones suggest a more balanced approach to financing. So a higher ratio above 50 and down to 100 or up to 100 can increase financial risk, while lower, moderate from 50 down 45 to 20 suggests a more balanced approach to finance. The implication is that a high, low, long-term debt to capitalization ratio may raise concerns for investors and creditors regarding the company's financial stability, as it suggests a significant portion of financing comes from debt, just almost the same concern as it has in the gearing ratio we just looked at previously in these previous videos. This can lead to higher interest obligations and a greater risk of default, especially in economic downturns. Conversely, a low ratio may indicate a more conservative financial strategy, reducing risk, potentially enhancing the company's credit worthiness. So a low ratio is encouraged. It's important to pursue because it's a conservative financial strategy. What are the cause and effects of a high long-term debt to capitalization ratio? Causes are aggressive borrowing strategies, significant capital expenditures funded through debt, and low equity financing. These are the clear causes. The effects are increased financial risk, where it goes above 50 and going to 100, high interest costs, potential difficulties in securing additional financing, and a higher risk of insolvency. This is critical. While a low long-term debt to capitalization ratio, causes are conservative debt management, strong equity financing, or retained earnings, and also increased shareholder equity. Like we've seen, less than 50%, 0.45 times to 1 equity shareholder ratio in the example share of 2 Nigeria players shows this is the cause. Ratio, and the effect is greater financial stability, low interest expense, enhanced ability to withstand economic fluctuations. This is key. So in conclusion, a long-term debt or the long-term debt to capitalization ratio is a vital indicator of a company's finance structure and leverage. By analyzing the relationship between long-term debt and total capitalization or equity capitalization, stakeholders can assess the company's reliance on debt financing and its overall financial risk. So analyzing this is a key skill for accountants to understand the relationship between long-term debt and the total capitalization in terms of debt and equity, and also the equity component and the debt component separately. It can help assess the company's reliance on these both methods of financing to be able to assess risk effectively. This is very important. So balance. It's the key word in all these ratios. Balance. It's crucial for maintaining financial health and ensuring long-term sustainability in a competitive business environment. This is very, very important. Thanks for watching Champions of Finance. Remember, mastering concepts like the long-term to debt capitalization ratio is more than just passing exams. It's about excelling in your profession and driving real-world value and driving real-world impact, and also adding value in your professional endeavors. Don't forget to like, share, and subscribe for more practical insights tailored to your journey. Drop your thoughts and questions in the comment section. I would like to hear from you. This will be the last in our series of long-term solvency ratios. We've looked at about 7 of them, and you could refer back to the videos. It's value adding, I believe, to you. We'll be looking at the next set of ratios, which are the final ratios and their investment ratios. Keep tabs on this. Keep learning, keep growing, and let's ace it together. Until next time, as we move to the investment ratios, bye for now.